Hey, this is Spencer Carenti with Alkaline Advisors, and right now I will be walking you through our premium multifamily acquisition financial model. So I'm going to try to run through this pretty quickly, just highlighting all the basic points and also explaining all of the nuances that this solves for. So this is a fully dynamic model, meaning you plug information in and then the rest of the model auto-populates. You'll see all these tabs down here. There are blue tabs, and those blue tabs are what we call inputs tabs. That's where a majority of your assumptions are going to be placed. And then from there, all of these tabs are outputs tabs. So this is our cover page. You could just pop a picture in here, and then we'll go to the inputs tab. So the inputs tab is where probably 90 to 95% of all of our inputs are housed. And within this blue tab, you'll see these blue cells. The blue cells are inputs tabs. Input cells. You put your information in these cells, and then all of the other cells will update automatically. So we've segmented this tab into different sections. You'll see project returns up top. You can see information on property level returns, assuming no debt, that's unlevered, assuming debt, that is levered, and then partnership level returns. You have the general partner returns and the limited partner returns. We'll talk about how to calculate those later on. So scrolling down, you'll see we've got general project information in this bucket. We've got some project timing. This is where you can choose the acquisition date. Are you selling the asset? How are we valuing the asset upon acquisition? So we can choose from some of these drop downs. Are we going to use the direct cap approach? So essentially, are we going to cap the NOI? And we can toggle, are we capping the in-place NOI, year one NOI, year two NOI, stabilized NOI? Are we choosing some form of purchase price? So we can choose just a general purchase price or purchase price per square foot. And that's how we can derive what we are going to acquire as the purchase price, what we are going to acquire this asset for. Then we have a couple of additional fees, acquisition fee, closing costs, just as a percentage of purchase price. We have a capital expenditure section over here. So you can choose, what added costs are going to be associated with the purchase price. For instance, maybe you have to do a roof repair. Maybe you are going to paint the exterior, maybe it's all the above, window repairs. So you can plug in your estimated budget per line item, and then when the cost is for that is going to start, and then when it's going to end. So for instance, we're saying this test is going to cost $100,000. It's going to start in month 3. It's going to end in month 5. So it's going to last 3 months, right? Starting in month 3, we have month 4, we have month 5. So this 100,000 will allocate evenly over this 3-month period, and we'll show you what that means on the cash flow tab later on. So you can then take a snapshot at stabilization, and then we're deriving the sale value of the asset in month 120 when it's time to sell, or whatever month you want, right? You can say that you want to sell a month 60 in year 5, and you'll see all of these outputs, they will update automatically immediately. So you can kind of see how that impacts your returns. So when we go to the sale valuation section, you can choose how we're valuing the asset based on the forward 12 NOI, the trailing 12 NOI, or the trailing 3 NOI at the time of sale. And then you can choose at what cap rate are you using to value that asset. We've got some selling costs associated at sale as well, which we'll all calculate and run through. So then we have operating inputs down below. We'll start with the rent roll. So depending on how nuanced you want to be, and by the way, this is just a template. We can customize anything. We can start from scratch with a custom model, or we can build upon this template. So if there's anything that you see that you want us to dig a little deeper into, or you want to structure a little differently, let us know. We're happy to build it out. So here, again, this is all just illustrative. So these are all phantom numbers, but we're saying that this project is going to have 150 units. They're going to be comprised of studios, 1 bedrooms and 2 bedrooms, evenly distributed, 50 units a pop. And, we can say that these are different sizes, right? But not 12,000, we'll do 1,200. But all this will be factored in, right? When you add anything here, it just flows through the model. So what we're going to say is the in-place rents are as shown here. And again, if there are actual historicals, we can load it in. But if we're kind of just forecasting back of the envelope to start, we can use general numbers. And then we can say, all right, well, if the studios in place today are 2,000, after we renovate, they're going to be worth 2,300. And we can choose, of these 50 units, how many are we going to renovate? So in this scenario, we're going to say we're going to renovate 20. How much are we going to spend to renovate each unit? So let's say we're going to spend $50,000 to renovate each unit. And we can do that for all of these units. And then we can say that for these 20 units, we're going to start the renovation in month 2, and we're going to renovate 10 units a month, right? But you can renovate 4 units a month, 20 units a month, you name it. So it'll tell you the start month, how many units we're renovating a month. And then based on the fact that we are renovating 20 units, we're going to end the renovation period in month 6. So all this flows through. Some groups like to do this. Other groups like to say that they're renovating all the units at the same time, starting in month X, ending in month Y. However you want to do it, we can customize, but this is just how our template does it now. And this flows through to the rent roll section and the cash flow section, which we'll get into later. So then we have other income and some reimbursable expenses. So for other income, you can toggle, how are we deriving this other income? Are we saying it's total income, or are we going to say that it's based on occupied units or total units, right? So we could say the income type is total dollar per year. In this case, everything will update. So then it's $30 per year versus if we say it's dollar per unit per month, now it'll say $30 per unit per month. And again, we can say, is it based on the total units or is it based on the occupied units? And this will, as I said, this will update. And we can assign a growth value per each individual line item, each individual income. So then we've got some rent growth per year, and then loss factors and vacancy factors. We have loss to lease, vacancy, concessions, other rent loss. Similarly, reimbursable expenses, similar to the other income. Is it going to be tied to occupied units or total units? Is it going to be a dollar per unit per month or total amount per year? And then what is that going to be? Then we have a reserves section over here where you can choose how we are valuing, or what are we putting aside for the reserves? Is it going to be a dollar per unit per month, or again, dollar total? And then we have taxes over here. So we have 2 ways that you can calculate taxes. Obviously, there are infinite ways to do it. You can either hard code taxes year 1 through year 5, and then we'll grow taxes at year 6 based on year 5 plus this growth factor, or we can use a goal seek. So I'll quickly show you what that means with the goal seek methodology. But essentially, we don't have any macros in this model. We don't have any circular references. What we're doing is, because in order to calculate we're using the value of the asset to determine what our taxes are. And in order to figure out what the taxes are, we kind of have to understand what the value of the asset is. So it's iterative, right? It's circular. So what we do is we use goal seeks to essentially say, iterate this on our behalf. So what we say is, I'll show you how to run the goal seek, but we have all the instructions down below. So goal seek instructions go to the ribbon bar, data, what if analysis, goal seek. So we go to the ribbon bar, data, we go to what if analysis, we go to goal seek. Okay. It'll say set cell field should be set to the red cell on the left side. So we've got set cell over here. We want to set that to 0 by changing this, the inputs tab. So once we do that, you'll see it is now 0, and all of that text went away because it's conditionally formatted. So now this is saying that we are going to we're taxing the stabilized value and the sale value at this 1.2% of the value. So if we come back down, and again, we can change this to hard-coded as well. So if we come back down to the financing inputs section, this is where we are determining if we have debt, if we have pref equity, if we have mezz debt, if there's a refi. So to quickly walk you through this, you can toggle whether or not you even have debt on the acquisition, right? Some groups like to acquire in equity and then refi upon stabilization or after any renovation. Here, you can toggle that yes or no. And you can choose what LTV, what loan to value percentage you want on the asset. And you can choose what costs are financeable. So right now we're saying that the purchase price is financeable, but no other costs are financeable, right? The closing costs, the acquisition fee, the project CapEx, and the renovation CapEx. Project CapEx being the information here, and the renovation CapEx being the cost to renovate each unit. But what we could do is we could say we do want to finance all those. Similarly, in terms of the interest rate, this is a toggle as well, a drop down. You can choose if we are using a fixed interest rate or if we have a floating interest rate. And the floating interest rate will have a floor and a ceiling, and we'll have points over SOFR, and then we'll tie to a SOFR curve, which will be pasted down below. So in addition to the acquisition loan, you might want pref equity, right? An additional slug to the capital stack, be it mezz debt or preferred equity. If not, you can say you don't want it, you can turn it off and it's not being calculated. If you do want it, you can say yes, you can choose the amount you want, and then you can choose what upfront fees are associated with this slug of the capital stack. Are there exit fees? Is there any current interest being paid on this? Is there any accrued interest being paid on this? Is there a minimum equity multiple? And of the free cash flow we have available while this is outstanding, what percent of it are we sweeping to pay down this outstanding pref equity amount? So we can keep this on just for illustrative purposes. You can also choose the upfront fee. Is it paid current or is it accruing? Then let's move up to the perm loan. So the perm loan is going to be the refi, and the refi will pay off the acquisition loan and pay off any pref equity over here or mezz debt that we can afford to pay off with proceeds. So first of all, if you don't plan on refinancing, you just want to pay off the acquisition loan with proceeds at sale of the asset, you can turn this off. But let's say we do want to refinance. So what we have built here, which is a pretty neat feature, is we can actually size the loan based on debt parameters that the lender provides, whether that's a minimum debt service coverage ratio or a minimum debt yield. What we're saying is we want a 60% loan to value. Let's say that right now the lender gives us a minimum DSCR of 1 time. Let's say there's an 8% minimum debt yield. Well, we are able to secure a 60% loan to value based on the fact that we're refinancing in month 15. It'll show you refi month. We're stabilized in month 7, but we're refining in month 15. We're going to value the asset with a cap rate, but you can choose, are you valuing the asset based on dollar per square foot or dollar per unit? But we're valuing the asset based on a cap rate in month 15 using the trailing 3 NOI, but you can toggle again what NOI you want to use. And we're saying it's going to be at a 6 cap. So say for instance, and right now with all of these parameters, we're securing a 1.4 DSCR and a 10% debt yield. So let's say the lender says that we need at minimum a 1.5 DSCR. So essentially the NOI needs to cover the debt yield the debt service by 1.5 times the debt service. So if we make this 1.5, you'll see this arrow, which was up at actual LTV, has dropped down to DSCR. And this actual LTV is popped up to be yellow, and it's changed from 60% to 56.1%. So essentially, this is saying that you can no longer secure a 60% LTV given all of these variables. The max LTV you can secure with that minimum DSCR of 1.5 is 56.1% LTV. So everything will just kind of be calculated for you in that regard. And then you'll notice the loan amount changes from what it was before to 20 million. So if we just go back and say there's no minimum DSCR, the loan amount is 21 million. Similarly, you can choose floating or fixed rate, and everything will see this is floating. We're tied to SOFR. You choose fixed, and now you're fixed. And then just to round this out, we have sensitivities down below. So we can sensitize the profit, the IRR, and the equity multiple at a project level, at a GP level, and at an LP level. And you can toggle based on what you want to see. Now, you'll notice this is red and this is yellow. That's great. We want that to be the case because this information is not correct as it stands. So what does it say? Note, if return cell is red, update the data table by going to formulas and calculate now. So if we go to formulas and then we click calculate now, it's iterating, boom. Now you'll see we are running the sensitivity accordingly. And this is a 2 variable sensitivity. We're sensitizing sale month and we're sensitizing exit cap. So we're saying right now we're looking at the levered profit, and we're saying that in month 120 at a 6% exit cap, our profit is $35.3 million. And if we tie this back up here, you'll see it's the same thing, 35.3. That's good. That's what we want. What the sensitivity allows us to do is say, well, what if we sell the asset early? Or what if we hold the asset longer? That's the x-axis. That's what this is saying. If we hold until month 126 instead of month 120 and we sell at a 6 cap, our profit's going to be 37 million, not 35 million. Similarly, if we hold that month until month 114 and sell at a 6 cap, it's going to be 33 million. And then same thing with the y-axis, we're sensitizing the cap rate. So we're saying, okay, well, what if we sell at a 6.5 cap or a 5.5 cap at month 120? It shows you the range. So if you're off by 1 point, 100 basis points for the cap in month 120, that's a $10 million difference, right? A $9 million difference. It's a significant amount. Similarly, we can showcase IRR. So if we do levered IRR, same thing, update, we'll click calculate now, it'll iterate, and it'll show you what that means on an IRR perspective. So you'll see your IRR decreases the longer hold period, which makes sense, time value of money, even though your profit is increasing. So different investors, different folks like to look at different metrics. So this is the inputs tab. I know it's been 15 minutes we've been on this one tab. Hopefully the rest of the conversation will be even less than 15 minutes total. So let's now hop to the cash flows. So when we get to the cash flows, all of the information from the inputs tab is going to roll into this cash flow tab. This is a property level cash flow. We like to separate it into different sections. So this is actually a 15-year monthly model. So you can see the cash flows go all the way out to year 15. So if we go back, that gives you the opportunity to analyze a deal that's 14 years or less, because if you want forward 12 for the NOI, we need to go up to that year 15. And just so you know, we have some of these user error checks built in. So if we want to analyze in month 300, you'll see sell must be less than 168. So I just wanted to call that out. So in this scenario, we break it out into different sections. We have acquisition, we have the operating statement, and the operating statement you can see we've got a snapshot at, and we can show even more information over here, break in the operating income out on a per unit per month, per unit per year, total per month, total per year basis. Just try to give you as many different angles of the numbers and of the data as we think you might be interested in. And obviously there are so many more ways to look at this, but we try to keep it as concise as possible. So you can see what the occupancy schedule looks like. You can see what the operating income looks like. And all of this is pulled actually from the rent roll tab. And this is specifically catered towards the units as we are renovating. So you can see the CapEx schedule, the renovation schedule, and all of this is just additional information. And you can see it on a per unit basis or a total basis. So going back to the cash flow tab, we have it broken out with acquisitions, then operating statement. So first the income, then the expenses, and then underneath we have the capital stack. So we have partnership equity, and this partnership equity we'll get into, that's going to be shown in the partnership return section. But partnership equity, we have pref equity, we have the acquisition loan, and then we have the perm loan coming in, and you'll see we're paying down the acquisition loan, and in this scenario we are paying off the pref as well. And then sale value in month 120 in this scenario, it's paying down the perm loan. All of that rolls into our net unlevered line item and our net levered cash flow line item. Unlevered being no debt, levered being debt. Exactly. We also separate it out into contributions and distributions. I say that modeling is really three things, to keep it as simplistic as possible. It's contributions, distributions, and timing. How much are we spending? How much are we receiving? And when? So what we like to do is break down all of those numbers, contributions based on the cost, and then break out the contributions based on the cost for the project, and then based on the shortfall, and then break out the distributions based on distributions from operations. What are we receiving on a monthly basis or on an operational basis? And then distributions from a capital event. So that could be refi, that could be sale, right? Or disposition. So now with that levered cash flow, we will move this one line item into the partnership returns tab. This is the partnership returns tab. You can see we have a GP-LP waterfall structure, and we give you the flexibility to calculate that partnership structure in different ways. So we could be pari passu, every dollar in, whatever the GP provides and the LP provides, every dollar out is separated equally, GP, LP. So in this case, it's a 90-10 split, LP to GP. So the distributions will be 90-10 as well. Similarly, if we want one hurdle, we can set a pref rate and say up to 8% IRR. Everything will be split 90-10. And then above 8% IRR to the LP, there's going to be a promote. So the GP will get a free 10% of all distributions above that 8% coming to the LP. And then there will be that 90% distribution. Stick with me for a second. For every dollar that comes in above the LP receiving their 8% preferred return, every dollar that comes in, 10 cents on that dollar is automatically going to the GP. Then you're left with 90 cents. And with that with that 90 cents remaining, that 90 cents is then split 90-10 LP GP because the GP has some equity in the deal. So you'll see that the distribution is actually going 19% of every dollar above that 8% IRR to the LP is being given to the GP. 81 cents of every dollar is given to the LP. And we can scale that up to 2 hurdles and then 3 hurdles as well. Similarly, we are giving people the flexibility to figure out how they're calculating their preferred return, how it's compounding. Is it compounding monthly, annually? Is there no compounding? How are our clients paying out their LPs, right? Are they distributing their cash flow to the LPs monthly, quarterly, annually? You'll see all that has bearing on the return metrics. And then finally, when is the equity contributed? If you're a GP, are you raising all the equity up front, or are you just going to deploy it when it's incurred? And you'll notice if it's incurred, it increases the IRR based on the time value of money because you're spending it you're not collecting it all up front, you're just spending it when needed. So you don't need to call it all at time 0. You can see right now it's incurred. We're at 17.8% IRR. And if we have it all up front, we're at 17.6. So it's pretty negligible, but where this kind of is a little more in depth or is the spreads a little more is if more costs are incurred further on down during the process of acquisition or renovation and so on and so forth. Okay, cool. So let's hop to the annual cash flow tab. You with me so far? I hope so. If not, feel free to reach out. Happy to answer any questions. Annual cash flow tab. This is like the monthly cash flow, just annualized. So everything is just in one section. And then we have the loan amortization, and you can just kind of get a better sense here. And we sell month 120, so in this scenario, this is month 121. You don't have to pay attention to that. So all of this information is then shown on our investor summary. So everything flows through. So this investor summary, you can see we have a snapshot of returns. Again, contributions versus distributions versus profit. We have it broken down from an unlevered perspective. So no debt versus a project with debt versus just the pref equity slug or mezz debt, however you want to see that. And then from the LP's perspective and the GP's perspective. If you don't want to show the GP's information, you can say no. I don't know why you wouldn't, but it's there. Then you have a snapshot at different times, key timing. So stabilization versus refi versus sale. And you can see revenues, expenses, NOI, and then some key metrics down below. We can customize these deal notes, but even the deal notes auto-populate. These are all formulaic, right? So the numbers will auto-populate. Sources and uses will auto-populate. The charts will auto-populate. The graphs will auto-populate. One cool thing to note here is you'll notice sources and uses equal each other, 31.1 million for sources and uses. Same thing with these charts. But the graphs over here aren't aligned apples to apples, right? You see there are these 2 bumps over here and no bumps over here. That is because we're calling all the equity and debt up front in time 0. And we're doing that because of upfront equity contributed. If we said incurred and we went back to the investor summary, this will update automatically. So if we then have the acquisition loan, we have the acquisition loan information, perm loan information, sensitivity over here, in place versus renovated. So again, just showing in place dollar per unit versus renovated dollar per unit. Operating statement, stabilized snapshot. This is, snapshot of operations at stabilization versus the snapshot at sale. And then we have a brief annual summary. You can literally just print this out. I don't even know if you'll be able to see this, but you can print this out and then it'll be a quick 2-page PDF. So keep scrolling down. if you expand this, you can even see the partnership return splits, or you can hide it. And this is on an annual basis. And then we also have one for the lender summary. So the lender summary, very similar, a little less information, and this is more so geared towards the lender's perspective. So you can see what the lender's contributions and distributions are, their profit, in their exit is in month 15 because that's when we're doing the refi, what's the value of the asset, and then we have the refi snapshot down below so that if they want to see that lender, the lender deploying the acquisition loan, if they do want to see what that looks like at refi, maybe they're interested in providing the refinance as well. And then finally, we have our disclaimer, which is just in the model saying that you will not be injured physically when using this model, unless maybe you spill water on your laptop. But we'll hope that's not the case. So I know we just went over a lot of information, 27 minutes. It's a lot of time. Maybe watch this in double speed. We could be a little more efficient with everything. But if you do have any questions, please feel free to reach out. Again, my name is Spencer Carenti with Alkaline Advisors. We are outsourced analysts, fractional analysts. We do a lot of different things for a lot of different groups. Call us. We can tell you what we do in more detail. But again, multifamily acquisition premium model. And I appreciate your time. I appreciate you listening to me walk you through this. Thanks. Have a great day.